Stock market. Volatility refers to price movements in the stock or the stock market as a whole. Volatility typically refers to the degree of variation of the stock price or stock market indices. It's a measure of how much and how quickly the stock or the market value changes over time. Stock market volatility can be caused by a number of different factors, including economic indicators, geopolitical concerns, company-specific news, and investor sentiment. Volatility can also be impacted by algorithmic trading, which can amplify the speed and magnitude of market movements. Stock market volatility can have both positive and negative effects on investors. High levels of volatility can produce great opportunities for people to buy at discount prices. However, huge swings can also make some investors nervous and can be tough for some, and it can make it tricky for new investors especially. Many investors will manage volatility by buying a broad range of securities, whether that be stocks, bonds, and other investments. And other investors might have a more concentrated approach, but with volatility they see it as opportunities arise and other movements to just ignore. A big thing to consider with volatility is that investors should remain disciplined and use common sense and not make any rash decisions just because the market moves rapidly. While it is very natural to feel anxious with big stock market movements, especially downwards, it is really important to just remain rational and not make any impulsive decisions. A great way to remain grounded in times of high volatility is to stay true to your long-term strategies and to use common sense in all your investing endeavors. To do this, it is very important to avoid trying to time the market or making predictions about future movements. Follow for more.